Mario Draghi at the ECB yesterday sent a strong signal of new stimulus for the Eurozone. Do you think that such actions to ease policy at other central banks around the world will put more pressure on the Fed to do the same?
Well, first, I think all central banks are focused on their domestic, their mandates are domestic, and they're focused on economic conditions from a domestic standpoint. And that goes for the European Central Bank, it goes for the Fed, it goes for all central banks. So that's our principal focus. So it could cut either way. You know, I would think that to the extent you see stronger financial conditions and stronger activity in the ECB after a rate cut, that would tend to support activity. So we're really focused on you know, the risks to on the baseline outlook, which is still a pretty favorable one, and the risks to those outlooks. That's our principal focus.
Howard and Chris.
Thanks. This is the first time that you've been really issuing SEPs in an era when rates are going to be going down. Two sort of related questions. Is there concern that you'll be causing a sort of dot deflation by telling people, well, don't buy your car now because it'll get cheaper in 6 months because we're cutting rates, and that could sort of fulfill itself? And secondly, on inflation, that was a pretty big drop in expected PCE, yet, you know, without reacting to it, are you not sort of undermining your own credibility in terms of commitment to the 2% target?
I'll take the inflation one first. I didn't quite follow your dot question.
Well, the fact that expected inflation went from 1.8 to Howard Schneider with Reuters went from 1.8 to 1.5. The fact that you're not responding to that.
That's the inflation question.
Yes.
I'm saying
no, the fact that you've signaled rate cuts are coming, was there any concern on the committee that this would tell consumers, tell people, don't borrow now, don't spend now because rates will get cheaper later?
All right. Okay, so let me answer the inflation question first. So we're saying that I noted in the statement and also in what I said here, we saw that market-based measures of inflation expectations, break-evens, dropped. We noted that also in the statement, and I noted it as a reason for us to one of several reasons why it feels to us that the case for more accommodation has strengthened. So we find that notable. Not only that, the actual forecast for inflation for this year among FOMC participants dropped a couple of tenths. So that means a more prolonged shortfall of inflation. Let me say on inflation, it's something I've been concerned about for quite a long time. It's one of the principal reasons why I called for the review in a world where policy rates are going to be closer to the effective lower bound, then just as a general matter, we need to be really strong on 2% inflation. So I think you know, we certainly don't want to be seen as weak on inflation, and I don't believe we are. In terms of the dots, you're right. This is the first time I believe we've talked about cutting in the dot era. I guess the dot era began in January of 2012, and you know, we're working our way through it, and I think. It's just something we do. You know that my view on the dots is that they overall provide useful information for people, but that we need to do our absolute best to explain what they are and what they are not. Speaking of which, they are not a forecast of the group. They're not discussed or debated at the meeting. They're an input to policy more than an output of policy. And they're also only the most likely case. So in a situation where there's relatively high uncertainty, there's the most likely case, but the second most likely case might only be a little bit less likely. But that doesn't show up in the dot. The dot is either one thing or it's another. So I just would say that if you pay too close attention to the dots, then you may lose sight of the larger picture.